When I ask the average person about their 401k, oftentimes they can't tell me much about it. They can't tell me what they're invested in. They can't tell me what the fees that the 401k provider charges are. They can't even tell me how much is in there a good portion of the time. This is quite troubling because a 401k is a major source for a lot of people of retirement income. This video is going to help you understand what is really important to know about your 401k. Now let's get into it, but before we do, please make sure you click subscribe and notifications so that you get alerted the next time I post a video. I post about twice a week. All right, point number one, timing. Being aggressive when you should be conservative and vice versa. There's a time and a place for everything. In your early years of working, generally speaking, people should be more aggressive in terms of where they put their money. Aggressive doesn't mean foolish. It means taking their money and putting them in well-known, well-traveled types of investment choices. Later on, when they get older, they start to migrate from the more aggressive to the less aggressive and more conservative type of investment choices. The reason that it's done this way is because in your early years, you have time to recover. In your later years, you do not. Let's take 2020, for example. Had you been invested in aggressive investments in your 20s or 30s, you would have seen your portfolio drop significantly March, April, May, June, and July, only to rebound in the back half of the year. But what if you had retired in the first half of the year and you locked in or you crystallized those losses? Conversely, had you been invested for the long run and had been in conservative investments and stayed in conservative investments, the subsequent run up in the stock market would not have benefited you either. That would be okay if you were in retirement and you needed to take the volatility out of your portfolio, but in your early to mid years of saving for retirement, conservative investments would not have been the best place to put your money. Point number two is putting your money in designer funds, as I call them. Basically funds that have a high fee structure but modest performance outcomes. One of the most common mistakes that people make is to equate higher fees with better performance. Some funds have high fees and average performance, but people equate the fund to safety and performance simply because they've seen a lot of advertisement associated with the fund. You see it happen all the time. People can't distinguish and are not trained to distinguish between a fund that charges a big fee and has modest returns and one that doesn't charge much of a fee at all but has outsized returns. People are willing to pay more for a name that they've seen time and again and feel comfortable with, even if that means just having an average return or worse. And I know you've heard this stat before, but 4 out of 5 money managers that get paid to outperform the S&P 500 index simply can't do it. Yet they charge high fees anyway. So why not put your money into an S&P 500 index fund that charges virtually no fees at all? I will point out that sometimes you don't have a choice. As a 401k plan participant, you don't get to choose where the money goes or what investment options there are to choose from. Inside many 401k plans, there isn't an index fund option. And sometimes there are funds that rebalance themselves, target funds that readjust the debt and equity combination based on your age and the target year that you plan on retiring. Sometimes those funds charge a little, sometimes they charge a little bit more, but not knowing what that charge is a big 401k mistake. Point number 3 is having a Vegas mindset because you don't need the funds today. All over the internet, there is extreme hyperbole about Bitcoin and cryptocurrency. Right now, there are a lot of people that think about Bitcoin as a massive payout that's pretty much guaranteed. That's what they think. Absolutely not true. In fact, extremely high risk. Still, this is what they think because they hear about it again and again and again. They think about cryptocurrency the same way people thought about internet stocks in the early 2000s. And we all know how that ended. When greed kicks in, people think that they can parlay their money into mega gains simply because other people are doing it at that particular point in time. But as you will see in a moment, this rarely works. If I ask the average person out there who knows very little about the stock market, what makes the price of a share of stock go up, most could say it's because the company is making money. They might not know how that works, but they know that profitable companies, their share price goes up. Those that lose money, their share price goes down, generally speaking. Not always, of course, but generally speaking. If I were to ask those same people, many of whom invest in Bitcoin, what makes the price of Bitcoin go up or down, they wouldn't be able to tell me. The reason, by the way, is because more people want to own it than want to sell it. So that digital blip, the value of that digital blip goes up. You have more buyers and sellers, and that bids the price up. But it would be a lot like investing in Japanese yen. What drives the price of Japanese yen up or down? Well, to the average person, they would have no idea. And the average person would never invest in Japanese yen. Yet they're invested in Bitcoin. So for your investments in your 401k, make sure that you fully understand why you're investing in those investments. Read all of the material available to you. Don't just pick something because somebody says this is a good idea. Point number 4 is missing the employer match. In other words, not contributing enough to get your employer match, which is free money. There's nothing better than getting something for nothing, and the employer match is just that. Many companies will provide a certain match to the dollars that you contribute to your 401k, but you actually need to contribute to your 401k to receive that match. Even if you don't contribute the maximum, and you should if you can, contribute the minimum you need to get 100% of the employer match. It's free money. Point number 5 is using the Roth option in your 401k when you should be using the regular option or vice versa. Many 401ks now offer both a Roth post-tax contribution option and a traditional pre-tax contribution option. With the Roth option, you contribute with post-tax dollars, but you take the money out tax-free. With the traditional 401k, you contribute with pre-tax dollars, so you get the big tax advantage now, but you have to pay taxes on the money when you take it out. I will say there's a huge fascination with the Roth because everybody wants tax-free money when they retire. And in many circumstances, it's the right choice. But the investments don't perform better in a Roth than they do in a traditional 401k. They're just using after-tax dollars to invest in those investments. What situations would you consider the Roth portion of your 401k versus the traditional portion? Well, in the early years of your career, you won't be paying a lot of taxes, so the contributions that you make to the Roth portion of your 401k will be made after tax, but the tax amount is very small. As you gain in your career and you earn more and more money, your tax rate goes up. And at some point, the amount of money that you're contributing may actually exceed the tax rate when you retire. So getting the tax break early is more important because you'll be paying less taxes in retirement rather than taking the funds tax-free after you retire. Generally, you should be contributing to a Roth if you think you're going to be paying more in taxes in retirement than you are at contribution. And you should be contributing to a traditional 401k option when you think you're going to be paying less in taxes when you retire than when you contribute to the 401k plan. Mistake number 6 is having no investment strategy once you actually retire. A lot of people think about what they're going to do with their investments up until the point where they retire. They think about the age-based funds that we talked about before, but how many people talk about what they do once they hit retirement? In retirement, you actually have different phases. Early retirement, you still may be able to take a little bit more risk than you would want to take in late retirement. Understanding what those phases are and where to put your investments in retirement is really important, so you actually should have a plan and a strategy. And the last point is letting someone else make all of your investment decisions and having no involvement whatsoever. The world is filled with people who blindly follow the advice of a financial advisor without understanding what's going on. These same people often lose some or all of their money. Think about all of the high-profile losses for sports figures, entertainers, Hollywood actors. These people entrusted their funds with an advisor, and that advisor didn't do a very good job or worse. But losing money with a questionable advisor doesn't just happen to the mega rich, it happens to folks with more modest income as well. In order to protect yourself against this, you need to take an active role in your investment choices and your portfolio composition. Understand what you're invested in and why, and most importantly, understand if this is a high, medium, or low risk investment. And ask yourself, is this the type of investment I want at this point in my life? If you like this video, please make sure you click subscribe and notifications. Retirement income is changing fast, and I work very hard to get what's out there and here for you. This is Jeff Schmidt. Thanks for watching.